Up on the Bloomberg terminal, the box is magic. Now, I'm joined by Lillian Co, who's Chief Investment Officer at LBN Advisers. Lillian, very good day to you. Thank you very much. You run the LBN China Plus Opportunity Fund. You've beaten 98% of your peers over the last 12 months, so definitely someone worth listening to right now. It's a long-short equity fund, and it's up, what, 27% over the last year or so, while the Hang Seng Index is down about 47%. What is your current position at the moment? What's your balance between long and short?
Basically, we are running a neutral position with a long bias. The macro this year is still quite bad, but valuations have come down a lot since last year. So there's no point to be very defensive anymore. So we are still running a neutral and yet with a long bias, and we are more willing to take on risk this year because we think that with all these measures coming out from the central governments, it will work eventually. So we are prepared to be more aggressive as we move to the second half.
That suggests, and we'll look at some of your individual picks a little later on, but that does suggest that where you're long is more in those companies which will benefit from government stimulus, and where you're short, it's those that maybe aren't, maybe the financial sector?
I think I will look at distressed assets this year as part of the theme in my long book because, as I mentioned earlier, valuations have come down a lot, and if we do move out of this recession, these are the assets that are likely to give you double or triple return if you take a 2-year view. But on the short book, I think I would focus on things that are relatively stretched in terms of valuations. So I think that's the name of the game this year. Okay,
well, we're going to start with the short book today. One of those is Shanghai Electric, and just before we get Lillian's discussion on that, let me cross over to Stephen Engel, who is in the newsroom, with a quick look at just what Shanghai Electric is up to and the challenges it faces. Steve. Thank you very much indeed for that. Stephen Engel with a look at Shanghai Electric. Back to Lillian. Now, you're shorting Shanghai Electric. Now, as Steve just noted there, Shanghai Electric has already said profit is likely to fall 10 to 13% this year. We have a chart which shows Chinese power production. If we can throw that up on the screen, that tells us basically the story at the moment, that Chinese power production has fallen pretty sharply. So this is fundamentally the reason you don't like it?
Exactly. Basically, I think the cycle for the power equipment sector has peaked. There was a rush for the power plants in China to spend on power equipment purchase in the last few years because of the strong economy, but now the tide has completely turned. Power plants in general are losing money big time, and they are suffering from falling utilization rate with high gearing. So they are more likely to cut capex in the next 1 or 2 years, and that is negative to power equipment sector. I don't really see this sector to bottom out until the earliest second half next year. So it's likely to be dead money for the moment. And valuation-wise, 12 times PE, but with negative earnings growth, I don't see why you want to have your money there.
Right, exactly. What have we got? We've got about earnings growth of -6%. That's earnings per share we're looking at is the average analyst forecast. But as we noted, the company said profit will drop 10 to 13%. And the long-term growth, again, an average or a median estimate by analysts, just 6%. I mean, this company's near the bottom of the cycle, I guess, or not near the bottom, entering into a downward trend in the cycle.
Exactly.
Okay. Estimated PE is 11.3. You're saying roughly 12. Stock's down 19% year to date. Median target price shows about another 3% drop, but could get a little worse than that. Let me take a look at another short. That is Hong Kong Exchanges and Clearing, which runs Hong Kong Stock and Futures Exchange. Profits down 17%. Volumes dropped. That was last year's profit. It also regulates initial public offerings, and that's become an issue, potential conflict of interest. 3 buys to 10 sells on the Bloomberg system at the moment, and you're definitely in the sell category.
Right. I think the story on Hong Kong Exchange is very simple. It's just simply too stretched in terms of valuations. It's now trading at above 20 times, depending on what sort of market turnover assumption you key in. But definitely the market daily turnover this year is going to be down from last year. And if you look at the valuations of global exchanges, they are in the teens, most of them. So you need to be an outright bull in order to be positive on Hong Kong Exchange, and so far I don't think I'll jump into that camp yet.
It's, I mean, presumably listings are going to be down as well this year, because they make money out of listings.
I think the daily turnover is really the big is really the big factor in determining the value of the stock.
Okay. What, though, if we're actually in a new bull market? I mean, there are people out there calling that. I mean, it's a risk, isn't it?
Yes, that is if the market turnover all of a sudden goes back to 100 billion per day, then you want to close your short on this one. But as far as I'm concerned, the daily turnover year to date is still like less than 50 billion a day. So it takes quite a bit to get to a 100 billion turnover. The
average, or the median, I should say, long-term growth forecast for this stock amongst analysts covering it is minus 11%. I mean, that kind of surprises me. A lot of companies are showing weak long-term growth at the moment, but not normally minuses. I mean, that does suggest that this company really is in quite an extended downtrend, potentially at least.
That is, if you think this is just a bear market rally, then definitely is a.
But this is a suggestion that a lot of analysts out there are going, wow, for Hong Kong, this could last a little while. Okay, just before we get to the break, I mean, on both these stocks, how much downside, I mean, when you're on your short book, how much downside do you take before you book a profit normally?
I think this year you don't really expect like 50% downside like you saw last year, because valuations have in general come down. And people are more willing to take on risks. So for these two shorts, probably you're talking about another 20 or 30% downside at most.
Okay. All right, great. Well, let's get some long recommendations after the break. I'm speaking to Lillian Co of LBN Advisers. More with our guest after the break. Do keep sending your emails. AsiaEdge@Bloomberg.net. I know it's Good Friday in a lot of countries around the world. Get on your computer, send us something. AsiaEdge@Bloomberg.net. Back in a couple of minutes.